Welcome back. Today on the Byte-Size Brief, we're going deep on OneMain Holdings, ticker OMF. And this is a company that's really a tale of two completely different narratives. You've got, on one hand, a financial powerhouse that is posting absolutely incredible growth. And on the other, it's facing a legal firestorm that threatens its entire business model. So, let's dive into this story. So, just look at this contrast. How does a company report a stunning 55% jump in earnings per share for the year and, at the exact same time, get hit with a massive lawsuit from 13 different state attorneys general? It's a classic Wall Street dilemma, right? Do you follow the numbers or do you follow the headlines? Let's unpack it.
So, first things first, we need to understand what OneMain actually does. At its core, it's a lending machine, and it's built to serve a huge and, often overlooked part of the American economy. We're talking about the roughly 100 million people who can't just walk into a traditional bank and get a loan. And that brings us to this key term, the non-prime borrower. This is OneMain's bread and butter. We're talking about folks who, for whatever reason, maybe a lower credit score, maybe an inconsistent income history, they're kind of locked out of that prime credit market. But they're a crucial group that still needs access to credit for things like cars, home repairs, or just consolidating debt. So how does this machine actually work? Well, it's pretty much a three-step process. First, they originate the loans, personal loans, auto loans, and now credit cards. Second, they service these loans through a really big network of about 1,300 local branches plus all their digital channels. And then there's this third step, which is absolutely crucial. They work to deepen those relationships. This means cross-selling new products to their nearly 3 million existing customers. This is great for lifetime value, but as we're about to see, it's also a central part of the current controversy.
Okay, so let's dig into that first story, the bull case, which is all about those impressive profits and payouts. This is the narrative that the company's leadership and a lot of investors are focused on. And to be honest, the numbers from 2025 are pretty staggering.
Let's start with the bottom line. A full-year net income of $783 million. And look, that's not just a big number. It represents a 54% explosion in profit compared to the year before. I mean, in almost any industry, that kind of growth is just eye-popping.
And here's what that profit really means for shareholders. The earnings per share, or EPS, it jumped from $4.24 all the way up to $6.56. That 55% increase is exactly the kind of explosive growth that gets investors very, very excited.
And the company is not just sitting on all that cash. They are aggressively rewarding their shareholders. First, they've raised the dividend, which now yields a pretty hefty 6 to 7%. And on top of that, they've authorized a massive $1 billion stock buyback program. That is a powerful 1-2 punch for investor returns.
The company's CEO, Doug Shulman, he summed up the bull case perfectly on their recent earnings call. The message is crystal clear. The business has strong momentum, the loan portfolio is solid, and they believe they have a disciplined plan for continued growth. That's the official story.
But then we have to flip the coin. And this is where things get really complicated. We're pivoting now to the bear case, which has nothing to do with spreadsheets or earnings reports. It's all about a gathering legal storm that really challenges the very ethics of how OneMain does business.
And this is the question every single investor has to be asking themselves. If the financial engine is running this hot, what could possibly be the problem? Well, the problem is coming directly from state governments and, more importantly, from the customers themselves.
This quote from New York's Attorney General gets right to the absolute heart of the bear case. The accusation is that OneMain isn't just lending to non-prime customers, it's actively exploiting them with hidden fees and misleading terms. This isn't some minor complaint, it's a fundamental attack on their business practices. So let's break down the specific allegations from those 13 state attorneys general. They claim the company traps borrowers in a cycle of costly refinancing, that they hide fees, and that they push expensive and often useless add-on products. Think of certain types of credit insurance, without getting clear consent from the customer. These are really serious charges of systemic abusive practices. And as you'd probably guess, the market did not like this news one bit. The stock took an immediate and significant hit, falling by as much as 12%. This shows you exactly how a legal headline can, at least in the short term, completely overshadow a fantastic earnings report. Investor confidence was clearly shaken.
And if you really want to understand the feeling behind the lawsuit, you just have to look at what customers are saying online. I mean, these are direct quotes from public forums. People are calling it predatory, they're warning about hidden interest, and some are describing their experience as the biggest financial mistake of their lives. This isn't just random noise. It's the real human story behind all these allegations.
So, where does this leave us? We have two powerful, completely opposing stories. Incredible profits on one side versus really damaging allegations on the other. The challenge for any investor now is to synthesize these two narratives and figure out how to balance this amazing performance against what is obviously a very significant risk. Okay, so here's a practical way to look at it, a sort of investor's scorecard. On the bullish side, the things you want to watch for are their loan losses or charge-offs. You want to see if they stay in that 7 to 8% range they've guided for. Also, keep a close eye on the growth in their newer auto and credit card businesses and see if they actually execute on that billion-dollar buyback. Then, on the bearish side, the red flags are obvious. Any new developments in the lawsuit and what the potential penalties might be. Also, watch their delinquency rates. That 5.65% figure is a sign of rising stress. And of course, keep an ear to the ground for any new, stricter regulations.
So, looking ahead, what are the actual events you should circle on your calendar? Well, first is their next earnings release for Q1 2026. We need to see if this incredible growth is continuing. Second, pay very close attention to any initial court rulings in that multi-state lawsuit. And then you have to watch the data on how their newest loans are performing, as well as the bigger picture stuff, like what the Federal Reserve decides to do with interest rates. Each of these is going to be a major clue.
And that brings us to the final, critical question that this whole story really boils down to. You've got this incredibly powerful profit engine just churning out cash and shareholder returns. But on the other side, you have these very strong legal and reputational headwinds pushing back. Which one is going to win out? That is the billion-dollar question for OneMain Holdings. That wraps up today's deep dive on OneMain Holdings, Inc., OMF. For a sharper, more candid discussion, join us on the full audio podcast. Drop your questions and takes in the comments. We read every one.